Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
This episode is brought to you by Latin Excellence. Visit latinexcellence.com. That's Latinx, CELLENCE.com or latinxmovement.com to learn more and shop our merchandise. You are excellence. Hello and welcome to another episode of On My Way to Wealth. My name is Luis and I'm your host. I hope you're doing well. Today I want to talk to you about inherited IRAs. So what are they? An inherited IRA is an individual retirement account that was owned by someone else that listed you as a beneficiary. They passed away and now the funds are yours to claim. So I wanted to make you aware of several different options in case you happen to be in that situation, because there are some rules that are going to apply and some options that you have that you can use to your advantage, because these rules are made by the IRS. So depending on your need for the money, your age, and also your relationship to the person that passed away, you're going to have a different set of rules and options. So there are some key things that I'd like for you to know. For example, RMD stands for Required Minimum Distribution. Right now, under the current law, a person that reaches the age of 72 must start taking required minimum distributions from their traditional IRAs. And these are things that the IRS sets based on a life expectancy table, because ultimately these funds have already been contributed pre-tax to this account, and they've been sitting there tax deferred. So the IRS comes knocking and says, okay, at age 72, you got to start taking money out so that we can start taxing you on it. Prior to the Secure Act, this was age 70 and a half was the rule, but now they expanded that to age 72. So what happens is this may impact you as well, because you may have your own required minimum distributions if you inherit an IRA, depending on your relationship and your age. So let's go into it. Let's talk about some of the rules for inherited IRA. So there are a few things that you need to keep in mind. Number one is the age of the decedent at the time that you receive the IRA, and the other one is your relationship. So let's start with spouses first. All right. So if you are a spouse and you inherited your spouse's IRA, you're going to have more options than people who are non-spouses. So let's talk about the spouse receiving an IRA if the spouse that passed away was under the age of 72, right, before the required minimum distributions. So the first option is you can treat the account as your own. Just basically do a spousal transfer and you transfer the assets into your own existing or new IRA, right? So basically, you're just going to take the proceeds from this inherited IRA and put it into your own IRA. And now the rules apply as if you own the IRA to begin with. So these rules are, if you are under the age of 59 and a half, you'll be subject to the same distribution rules as if the IRA had been yours all along. So that means that under age 59 and a half, if you make a distribution from this account, you're going to have to pay a 10% early withdrawal penalty in addition to income taxes on the account. So this is very important, because if you feel like you may need the money from this account and you are under the age of 59 and a half, transferring the assets to your own existing IRA may not be the best option, because now you're going to be subject to that additional 10% penalty, right? So this is one of the things that you need to definitely discuss with your CPA, tax attorney, or your financial advisor to make sure that you do what is in your best interest based on your situation and your plans. All right. Now, some of the benefits of transferring the account to your own name, your own IRA, is that you can designate your own IRA beneficiaries. You can also continue to have tax deferred growth in this IRA. So let's say you don't need the money. Now you don't have to start taking money out of this thing until you are 72, right? So then you yourself can also pretty much stretch this IRA for as long as you can until you're required to take the minimum distributions. Now, what if you transfer it to an inherited IRA instead? So instead of taking the IRA and put it into your own existing or new IRA, the other option is to open up an inherited IRA. And then you have two options there. One is the life expectancy method. And again, remember, I'm talking about spouses right now. If you do the life expectancy method, then the required minimum distributions are mandatory, but you have the option to postpone them until when the decedent would have attained age 72 or December 31st of the year following the year of death. So the distributions must begin no later than December 31st of the year that the account holder would have reached 72. That's basically the rule. So it's another way for you to kind of not have to start taking money out right away. Now, things to consider. Your annual distributions are going to be spread over your single life expectancy, which is determined by your age and the calendar year following the year of death, right? And that gets reevaluated every year. This is an IRA's life expectancy table. Another very important thing, if there were multiple beneficiaries to the account, and that happens a lot, right? Somebody may pass away, they might leave a portion of it to a spouse, portion to children or siblings and so on. Now, separate accounts must be established by December 31st of the year following the year of death. Otherwise, the distributions will be based on the oldest beneficiary. So you definitely want to make sure to keep track of that as well, because it may not be the most beneficial to start taking distribution based on the oldest beneficiary, especially if you happen to be a younger beneficiary. So you want to make sure that everybody takes their portion if there are multiple beneficiaries, and that way you can do it based on your own life expectancy. Now, one of the benefits of doing an inherited IRA is that there is not the 10% early withdrawal penalty. So if you think you're going to need the funds from this IRA and you are under the age of 59 and a half, then doing an inherited IRA might be the best choice, because now you can tap into it, take your required minimum distribution or whatever you're going to take out and not be subject to that 10% penalty, right? So that is a key factor there. And as the same as the IRA ownership, you can designate your own IRA beneficiary as well. Now, the second option for an inherited IRA, you can do the 10-year method if you're a spouse. So you have that option. You transfer the assets into the inherited IRA held in your name, and same rules apply. You have until December 31st of the 10th year in which the account holder died. And the account needs to be taken out no later than the 10th year. So you could leave the account there. There's no required minimum distribution for years 1 through 9, but you have to take it all out by year 10. So this gives you planning opportunity, because now you have 10 years to figure out, will I take this money out? And then what am I going to do with the money? Am I going to be in a lower or higher tax bracket? There might be some planning opportunities there, right? If you were going to take some time off for certain circumstances and your income won't be as high that year, that might be a good year to start taking more out of it. So it provides you some planning opportunities, both to keep the account growing tax deferred and also to kind of time when you want to make those distributions to make it to your advantage from a tax perspective. So just keep in mind you are taxed on each distribution, but you do not incur the 10% early withdrawal penalty when it's in the inherited IRA, right? And then any undistributed assets can continue to grow tax deferred up to 10 years. So December 31st of year 10, you got to take the balance out. And again, you can also designate your own IRA beneficiary. Now, another option, obviously, you can take the lump sum distribution. Nobody's stopping you from doing that, but this is something that you have to be very cautious about, because a lot of the times you might be tempted to do that and say, hey, listen, I inherited this IRA. I'm just going to take all this money. Can you do that? Yes. However, keep in mind that you will pay income taxes on that money. So depending on the balance of that account, it might actually push you up a bracket or two, depending on the balance. So this is something that you really want to make sure you consult with a financial advisor or a tax professional, because it's going to be income taxes. Even though you're not incurring the 10% early withdrawal penalty, you still will pay income taxes on that money, right? So you want to make sure that you talk to an accountant. So I'm going to stress that out, because that is a huge thing, especially if you live in a state that has that taxes retirement income and that has a high tax bracket. Combined between federal and state, you might be paying a hefty tax bill. So you want to make sure that you know what you're getting into, as that may not necessarily be your best choice. Now, continuing to talk about spouses, what if the person that passed away was over the age of 72 and they were already required to take the minimum distribution? The rules are going to be pretty similar. Same thing, right? So you can do a spousal transfer where you transfer the assets into your own existing or new IRA. You can take money at any time And keep in mind that any withdrawals made before age 59 and a half, you're going to have that additional 10% penalty. This is only available if you are the sole beneficiary. So this is also very key. If you are the only beneficiary to the account, then you can transfer the assets into your own existing IRA. If you're not, then you have to split the account with the other beneficiaries, and all of them have to do it by December 31st of the following year, following death. Now, if you are under 59 and a half, you'll be subject to the same distribution rules again, just as if the account was yours, including the early 10% penalty. Benefits, you can designate your own beneficiary. Now, one thing to keep in mind is that because the decedent was over the age of 72, you must take a required minimum distribution for the year of death if the account holder had not already taken it. So this is something that you kind of have to figure out once you call the custodian and say, hey, did this person already take out their RMD for the year? And if they didn't, then it's your responsibility to do so. This is huge because if you do not take your RMDs, the IRS has a pretty hefty penalties, 50% of the amount that should have been distributed. So this could be atrocious, right? You definitely want to fall into that category. Option 2, if you're the spouse and the decedent was over the age of 72, again, same thing. You can open up an inherited IRA. You can do the life expectancy method, or you can do the lump sum distribution as well. And you can do the 10-year option, but just keep in mind the taxation, right? Again, the inherited IRA part is going to be the most beneficial if you are under the age of 59 and a half, because you don't have to worry about paying the additional 10% penalty if you are going to tap into the money. But the main key differentiator here, when the person's over 72, is that you have to make sure that the distribution that should have been taken out by the decedent is taken out by December 31st if they had not already taken it out, which is a key thing to keep in mind and keep track of. Again, you can do a lump sum distribution, but keep in mind that you are going to pay taxes. So even though there's no 10% penalty on the IRA, you have taxes on the lump sum. So be very careful, especially if you don't need the money, because I've spoken to some people who did not need the money and their first instinct was, oh, I'm just going to take it all out and put it in the bank, and not realizing that they could lose close to half of that between, penalties and income taxes and state taxes. And also something that I really urge you to speak to a professional about before you take any money out, because it's going to matter your age, your relationship to the decedent, and whether you need the money or not, right? Key differentiators there. Okay, non-spousal options. If you inherit an IRA from someone other than your spouse, there are different withdrawal rules depending on the type of beneficiary that you are. So there are two categories. One is an eligible designated beneficiary, and the other one is just a designated beneficiary. If you are an eligible designated beneficiary, this means you are either a minor child of the original account holder, those that are chronically ill as determined by the IRS, those that are permanently disabled as determined by the IRS, or those that are not more than 10 years younger than the original account holder. So if you fall in one of those four categories, you are considered an eligible designated beneficiary, and you're going to have a different set of rules. If you're simply a designated beneficiary that does not fall in the above categories, like being a minor of the original account holder, you're not chronically ill, you're not permanently disabled, and you're not more than 10 years younger than the original account holder, then you're just a designated beneficiary. So the rules are different, right? And just to keep in mind, I'm talking about for those that died after January 1st, 2020, because there's different rules for those that died 2019 and before. Right. So I'm just talking about those that fall under the Secure Act now going forward. So if you are just a designated beneficiary, you'll be required to fully distribute all of the assets by the end of the 10th year after the account holder had died. So even if you don't need the money, you now have your own required minimum distributions. So you must take all of the money out within 10 years. Now, one of the benefits is you don't need to take it all out at once. You don't need to necessarily take money out every single year either. You just have to take it all out by the end of the 10th year. So again, it provides you with some planning opportunities. So maybe you don't need the money now. You might need it later. There might be some situations where you may fall under lower bracket, and you might have some opportunities there to kind of plan out your distributions over that 10-year span. All right. So now let's talk about those that are eligible designated beneficiaries other than the spouse, right? So again, these are the minor children, those that are chronically ill, permanently disabled, or now more than 10 years younger than the original account holder. If that's you and you inherit a non-spousal IRA, let's go through those rules. If the account holder was under the age of 72, you can still do the life expectancy method, which is something that was available before the Secure Act came out. And what that means is that the required minimum distributions are based over your own life expectancy, your single life expectancy. So this is determined by your age and the calendar year following the year of death, and gets reevaluated each year. But technically, you can stretch this IRA out based on your life expectancy. So, which is great if you don't need the money, because then you get to let the account, for the most part, grow tax deferred and only take out the required minimum distribution. One of the things that is really good about this is that you do not pay the 10% early withdrawal penalty. You just pay income taxes on the distribution. You can designate your own IRA beneficiaries. And another thing to remember that I mentioned before is just remember, if there are multiple beneficiaries, you must separate all of the accounts by December 31st of the year following the year of the death, because otherwise the distributions will be based on the oldest beneficiary. So you definitely don't want to do that. Option 2 is using the 10-year method. And that is the same thing like we talked before. You basically transfer the name into an inherited IRA. And at any time before December 31st of the 10th year after the year in which the account holder died, then you have to take all the money out. Benefits, again, you do not incur the 10% penalty, and you can kind of just stretch that out for that 10-year period. You can designate your own IRA beneficiary. Again, another option is to just take all the money out. And if you do that from an inherited IRA, you will not incur any 10% penalty, but you still incur taxes on that, right? So something to keep in mind. And, I'm talking about inherited IRAs that were pre-taxed, not the Roth IRAs. I may have to do another episode on that because it's another set of rules, and I certainly want to keep things as simple as possible. Now, what if the account holder was over the age of 72 and you have the inherited IRA and you're eligible designated beneficiary? All right, so again, same options. You can open an inherited IRA, do the life expectancy method. The only thing that's going to change here is that you have to take the distribution that the original account holder should have taken in the year of death if they had not already done so. So you have to find that out. Was the required minimum distribution taken out? If not, then you must take the amount that was required by December 31st of the year of the original account holder died, right? Again, you can do a lump sum distribution. All assets get distributed to you. You pay taxes on it. There's no 10% penalty. You can get all your money all at once, but just keep in mind that this may put you in a higher tax bracket. Now, another thing that some people might not be aware of is that you can also disclaim all or part of your inherited IRA. And what that means is you basically say, listen, I don't want this money, and I just want it to pass down to the next eligible beneficiary. Now, why would you do that, right? Well, I did an episode about generational wealth, the last episode. This is one strategy where you can continue that legacy. So let's say that you were the spouse of the deceased and you are getting a pension or any other assets that were left to you, and you feel like that's enough and you don't need this IRA money. You could disclaim it. And let's say it was you and a child that inherited this IRA, right, as primary beneficiaries. You can let your portion go, and then it all goes to the next beneficiary in line. If they're younger, now they can stretch that IRA for over the life expectancy, right? Let's say if they qualify as a designated eligible beneficiary. So that could be another strategy when you must say, you know what, I'm gonna let this pass, let it go to my child, and let's stretch this bad boy out, right? So that could be yet another tool that you can use if you don't need the money to have at your disposal. There are some rules, like if you're not a spouse, you have up to 9 months after the owner's date or death to make that claim and basically just say, hey, I don't want these inherited assets. So there's so many different strategies you can use, which is why, again, I really recommend that in cases like this, especially if you inherited an IRA, you definitely should be talking to a CPA, a tax professional, an enrolled agent, a financial advisor. Figure out, based on your age your relationship to the decedent, and whether or not you need this money, that's the thing that's going to impact the decision that you make based on all those circumstances. And, if you make the wrong move, you can end up costing yourself a lot of money in taxes, right? So why give Uncle Sam unnecessary money if you don't need to? Make sure you plan ahead and you take into account these rules. They can be confusing. Believe me, it's they keep changing, right? 2 years ago, they were different. So that's why you want to work with somebody that stays on top of all this stuff. So that's it in a nutshell. I will probably do another episode about the rules for an inherited Roth IRA because they technically have their own set of rules. They might be a little better because the Roth IRAs were contributed after tax. So for the most part, if the account holder already had the account for over 5 years, then you might be in good shape where you can have there'll still be requirement minimum distributions, but they wouldn't be taxed, so that's completely different ballgame there. But nevertheless, a lot of planning opportunities. So I hope you find this information useful. As always, if you have any questions, send me an email, luis@onmywaytowealth.com. And see you in the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.